The S&P/ASX 200 closed lower for the sixth straight session on Tuesday, falling 0.6% to 8,710. That is the index's longest losing streak since 2022. 6 days, consecutive. The kind of run that makes fund managers check their calendars to confirm nothing is broken in the machinery. And yet, on the same Tuesday that the ASX hit a fresh 3-week low, Satya Nadella sat down with the Australian and announced that Microsoft would spend $25 billion in this country over the next 3 years. $25 billion, the largest single investment Microsoft has ever made in Australia. Possibly the largest technology infrastructure commitment any foreign company has made here, full stop. The ASX fell on war limbo, on inflation anxiety, on energy sector dominance crowding out everything else. Energy was the only sector that gained. Healthcare was hammered. CSL dropped another 2.5% to its lowest price since August 2017, now down 47% year-on-year. Mining stocks slid. Banks slid. The index erased its gains for the year, falling into negative territory for 2026, while Wall Street in the same week notched record highs on the S&P 500 and Nasdaq. The divergence is striking. As one Share Cafe analysis noted, Australian investors may soon become the beneficiary of global rebalancing. Global funds maintaining benchmark weightings would need to rotate out of the US and into underperformers like Australia. But that rebalancing hasn't started yet. What has started, quietly, without a corresponding market reaction, is the largest technology infrastructure build this country has ever seen. The question the market seems not to have asked is, what does Microsoft know about Australia that the index doesn't?
Microsoft's commitment includes AI supercomputing infrastructure, expanded cloud capacity, 9 new data centers already under construction, and a pledge to train 3 million Australians in AI skills. A portion of the investment is earmarked for cybersecurity, in partnership with the Australian Signals Directorate, a detail that carries its own weight given the Iran conflict has, according to Microsoft's own statement, triggered a sharp rise in cyber attacks globally. This is not a promise. The $5 billion data center build is already underway. The $25 billion is on top of that. To put the number in proportion, the entire Australian federal government's annual capital budget, infrastructure, defense, everything, is roughly $25 billion. Microsoft is matching it, in one country, in 3 years, for one technology. Nadella's framing was pointed. He called AI the great hope for reversing Australia's flatlining productivity. He also acknowledged that the same AI would bring significant job displacement. That is an unusual candor from a technology executive at a press event. It suggests the investment thesis isn't about consumer sentiment. It's about infrastructure locking in before the next cycle arrives. Here is where the conventional narrative strains. The ASX is falling because inflation is expected to surge to 4.8% in Wednesday's CPI print, far above the RBA's 2 to 3% target. The RBA is now expected to hike again. Higher rates compress valuations. That logic is sound. But infrastructure investment of this scale doesn't respond to a single rate cycle. Microsoft's $25 billion commitment is being made into a rising rate, falling index environment, which implies its internal model is calibrated to a horizon well beyond 2026. The data centers being built today will operate for 15 to 20 years. The wrinkle is this. The same inflation that is suppressing the ASX today is partly a product of the Iran war's oil shock. Brent crude pushed past $108 on Tuesday. That shock is by design, temporary. When it resolves, the rate trajectory changes, and the infrastructure that was commissioned during the panic will already be in the ground.
There is a precedent for this pattern, though it is not recent enough to feel familiar. In 2012 and 2013, Amazon Web Services was quietly building data center capacity across Asia-Pacific during a period of market volatility and compressed tech valuations. The investment looked premature against the cycle. By 2016, AWS was generating more operating profit than Amazon's entire retail division. The infrastructure laid during the down period defined the competitive landscape for a decade. Microsoft's Australian commitment carries a similar logic. The question is not whether $25 billion in AI infrastructure creates long-term value. It is whether the timing, during this 6-day ASX losing streak, ahead of a likely RBA hike, with the Iran conflict still unresolved, implies that the window for this kind of commitment is narrower than it appears. The current evidence leans toward the infrastructure thesis holding. Microsoft's investment is capital already committed, not contingent on rate resolution. The Anthropic appointment of an Australian managing director, announced separately today in the AFR, suggests the AI build-out in this market is competitive and accelerating, not pausing. Australia leads the global shift into private markets. 93% of Australian institutional investors plan to increase private market allocations over the next 5 years, compared with 81% globally, according to Nuveen's Equilibrium survey. The money is not leaving Australia, it is repositioning within it. The condition that sustains this picture: the Iran conflict moves toward resolution, the RBA hike cycle peaks at 1 or 2 more moves, and the CPI print on Wednesday comes in at or below the 4.8% consensus. If those conditions hold, the ASX's 6-day losing streak becomes the kind of trough that, in hindsight, preceded the next infrastructure-driven re-rating. The condition that breaks it: inflation prints above 5%, the RBA signals an extended hiking cycle, and the divergence between the ASX and Wall Street deepens without the global rebalancing rotation materializing. In that scenario, even a $25 billion infrastructure bet lands in a market with no near-term catalyst to reprice it. Wednesday's CPI number is the first measurement point, not because it changes the infrastructure investment, it doesn't, but because it determines whether the rate cycle compresses the timeline for that investment to matter to investors. Watch the headline print against 4.8%. That number will tell you whether the market's 6-day pessimism was rational pricing or a gap that's about to close. The ASX fell 6 days in a row while one of the world's largest companies put $25 billion into the ground here. That gap resolves one way or the other. The question is which side closes first.